This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Partnership law. We're on Chapter 9 of the F4 notes. According to the 1890 Act, the Partnership Act 1890, a partnership is defined as the relationship which subsists between two or more people carrying on business in common with a view to profit. Much of the present-day partnership law is based on the principles established by this Act. Partners may agree amongst themselves how the firm is to operate, but their arrangement must be legal. The case Everton-Williams, I'm not sure, I've never been able to find the case, but I believe it's a genuine case about partnership law going back into the 18th century, about a partnership between two highwaymen, and of course being an illegal activity, the partnership principles did not apply to them. The business must be being carried on as well. It can't just be a single act or a single act from the past. It has to be therefore more than a one-off transaction, and it must also be a continuing course of business. It must be made with a view to profit, and is more than simple sharing of gross revenues. There's a case called Cox and Coulson, where the sharing of gross revenues was claimed to indicate partnership, and the court said no, it's a view to profit more than the simple sharing of these revenues. If a business relationship satisfies the definition, then the courts may well determine that a partnership exists, regardless of any written documentation or whatever the two parties intended. If the courts are satisfied that the relationship between these people does satisfy the definition, then the courts will claim that it is a definition. This is important because if there is a partnership in existence, the acts of every partner bind the firm and the partners, unless the partner was exceeding his authority and the other party was aware of that fact or was not aware that the person was a partner. So every partner is an agent of the firm and the other partners for the purpose of the business of the firm. Partnerships are formed by agreement. In the internal arrangements are a matter for agreement amongst the partners, and they can agree whatever they want so long as it is legal. Typical matters to be included would be A. Accounts and audit. Partners must agree who will keep the accounts, whether we're going to have the accounts audited, what the year end is going to be. They can choose anything they want, but it's by agreement. They would typically include this matter within the partnership agreement. D. They need to resolve what should be the division of profits. Should they be equal, or should they be in a different ratio, 60%, 40%, or 30-30, 40? The division of profits is necessary that they should be agreed on before they start the partnership. D is reference to drawings and relates to an agreement as to how much each partner should be allowed to draw in advance of being credited with their share of the partnership profits. C relates to the capital of the firm. Is the capital fixed, and each partner therefore will contribute a fixed amount of capital, or is it to be floating? Is it to be a variable capital? How much can each partner withdraw from the firm if necessary? I is for interest. They need to make some sort of agreement as to whether interest shall be credited on the different capital accounts, or whether no interest is to be credited. Or similarly, we need to think about any overdrawn current accounts. Is it potentially the case that if a partner overdraws his current account, then he should be charged interest on that borrowing from the firm? S is for salaries. Partners need to agree. Why should one partner work all day, every day for the benefit of the firm, whereas other partners who may be sleeping partners or take no active part, why should they, working partner, not receive a salary? And so salaries need to be agreed upon, and if one partner is doing excessive work or working and other partners aren't, then it seems fair that maybe a salary should be payable. C relates to current accounts, current and capital accounts. Some partnerships may maintain just a single account for each partner, so a combined capital with current account, whereas others may find it expedient or sensible to keep the capital contribution as a separate account, and any day-to-day movements or year-to-year movements other than capital being introduced would be recorded through the current account. G. We need to think in terms of how to calculate the goodwill in the event that a partner dies or retires. It may be a simple matter. It may say that goodwill shall be assessed by an independent valuer, or goodwill shall be no more than 10,000, or something more complicated. Goodwill should be counted as the greater of the average profits for the last 3 or 5 years. But whatever, there really should be some formula or basis for the calculation of goodwill in order that retiring or dying partners' estates should be treated fairly. And T is for time, the time limit of the partnership. Very rarely, I suppose, very rarely will a partnership be created for a fixed period of time, but of course it is possible. If there is no fixed period of time, then this is called a partnership at will, and a partnership at will is capable of being dissolved by any partner at any time simply by sending notice. We move to the next page. The 1890 Act may need to be referred to. I mentioned a moment ago that partners can agree to do anything so long as it's legal. In the event that partners fail to make an agreement about some matter or fail to discuss it, and this is then the subject of some later dispute, then the 1890 Partnership Act establishes what should happen. It's used as a default mechanism. Partners may set aside the provisions of the Act. They can agree to do whatever they want, so long as it is legal. But if they fail to agree, then by default we will look at the 1890 Act to see what that specifies. The specifications here are M. M is management. It means that every partner is entitled to take part in the management of the firm. Of course they can agree that any partner should be excluded from management, but that exclusion is an exclusion by agreement. And if there is no such agreement, then every partner can take part in management. E is equality. In the event of contrary agreement, equality in the 1890 Act says that partners shall share equally in the division of profits. This has also been held to indicate that in the event that a partnership makes losses, then those losses shall be borne equally. D refers to a situation where a partner may derive some benefit as a result of his use of firm assets. D then is for derived benefit, and the 1890 Act says that where a partner derives a personal benefit from their use of the partnership assets without consent, then he must account for and pay over to the firm all the benefit so derived. I is for indemnity, and partners are entitled to be indemnified by the firm and their partners in respect of any personal liabilities incurred by them or payments made by them in anything necessarily done to protect the firm or its property. An indemnity is where one partner says, well, if you have to do something to protect the firm or its property, then I will contribute towards your out-of-pocket expense or towards the money which you personally have had to pay. So an indemnity is a sort of guarantee amongst partners that if one partner has to pay money out, then they will all make a contribution towards that outflow. C is competition. Partners should refrain from competing with the firm. Where in fact a partner does carry on a competing business, then that partner, without the consent of the others, then that partner should account for and pay over to the firm all profits made by them out of that competing business. S. In the previous list, one of the things which partners typically would agree to is whether or not salaries should be paid. The 1890 Act steps in. If there is no mention about salary and as they're arriving at their agreement, then the 1890 Act says this about salaries. It says no partner is entitled to a salary as of right. They can agree differently, but if there is nothing in any agreement, then no salary is payable. Similarly with I, interest. No interest is charged on overdrawn current accounts. No interest is credited on capital accounts. They can agree differently. They can say that 2% interest should be credited on capital accounts and 4% interest should be charged on overdrawn current accounts. But if there is nothing in the agreement and if it's not discussed and agreed upon, then the 1890 Act plays a part and says no interest on capital accounts. No interest charged on current accounts overdrawn. However, interest at the rate of 5% per annum is creditable on loans and advances made to the firm by a partner over and above that partner's agreed fixed capital. So interest at the rate of 5% per annum on loans and advances made to the firm over and above agreed fixed capital. N is about the introduction of partners, new partners into a firm, and N is for no new person may be introduced as a partner into the firm without unanimous consent. If I wanted to retire from our partnership and were to bring along my 18-year-old son, a nice character, wonderful person, and I think you'd very quickly get used to his green hair, his green spiky hair, and if you look beyond the nose piercings and the eyebrow piercings and the tattoos, if you look beyond, I think you'll find that he is a suitable person to take on the role and responsibilities of a partner. All right, his clothes are distressed and he has the habit of walking barefoot, but I'm sure you can accept that he would make a good partner. Probably not. It would seem that a sensible provision within the 1890 Act is that if there is any one partner who objects to the introduction of a new person, then that new person cannot be introduced as a partner. B is for books of account. Books of account says that the partnership accounting records shall be available for inspection by any partner at any time. E is the other side of no new person may be introduced as a member. E is for expulsion and says that no majority can expel a partner. No majority can expel a partner. So it doesn't matter if there are 10 partners and 9 vote in favour of ejecting or expelling the 10th partner. It doesn't matter, 9-1 majority is not enough. It would have to be unanimous. However, don't forget that they can agree to do differently. Any firm can agree whatever they want, so long as it's legal. And D is for disputes. Disputes, ordinarily, disputes in the ordinary course of the firm's business would normally be settled by majority. A simple majority, 11 partners. If 6 vote in favour and 5 vote against the disputed matter, then the majority wish shall prevail. However, there is a little bit to add on that, and that is that no change may be made in the nature of the firm's business without unanimous consent. Those of you that are used to me will probably know that I like mnemonics. This one is medics, which is another alternative word for doctors. Medics in bed. The previous one, which I should have mentioned at the time, the previous one will probably not mean a lot to people not particularly from Manchester. But this is the examination centre, which used to be the examination centre in Manchester, was the Cooperative Insurance Society building, the CIS building. And we have a reminder here to add the CIS capital gains tax. If you can think of a better mnemonic for those letters, I would appreciate it if you would let me know. So add the CIS capital gains tax and medics in bed. Next subtopic of partnership is dissolution. We've got dissolution, automatic dissolution by court order dissolution. And again, we've got the mnemonic, and the mnemonic itself is dissolutions. So let's have a look at that. These first 6 on the screen now, these first 6, dissol, are automatic grounds for dissolution. That is, if one of these 6 happens, then the partnership is automatically ended. There's no need to go to court and ask them. It is a matter of fact. It's not a matter of subjective opinion. It's not a matter open to dispute. It's a matter of fact. The last 6, the utions, this is where a plaintiff will have to go to court and satisfy the court that there are reasonable grounds for determining or for ceasing or closing the partnership. And so this is very much arguable. It's open to dispute. It's open to the subjective assessment of the court and the quality of the argument put forward. So let's have a look at the different ones of the 12. Remember, this has been a recent past exam question. On what grounds may a partnership be brought to an end? D is death. Death of one of the partners. It's an automatic thing that death of a partner brings about the end of the partnership. It may be that within the partnership agreement it says that the death of a partner is the end of the partnership, but the remaining partners may continue to use the name of the former partnership. But death is the end of the partnership and the start of a new one. I is insolvency, where the firm or where any partner becomes insolvent, then that's the end of the firm and the partnership is ceased. So the insolvency or bankruptcy of a partner will bring about the end of the firm. S is the equivalent of insolvency or bankruptcy. S is where one partner secures or one partner charges his share of the partnership as security or settlement for his private debts. If a partner in an accountancy firm owes his window cleaner money and doesn't have any money, if he says, "I'm sorry, but all I have is my 1/3 share of the partnership in this accountancy partnership, so I can offer you that as security," then that is a share being charged by a partner, and that itself is sufficient grounds for an automatic dissolution. The second S is the sending of notice. Where a partnership is created not for a fixed term, this is a partnership at will. And if one partner sends notice in a partnership at will to all the other partners, then that will automatically bring about the end of the partnership. O relates to the situation of a joint venture, and the O means the object of the venture is ended or is over. A joint venture is a partnership of a particularly limited nature, for a particular course of trade, adventure, or voyage. Well, at the end of that voyage or course of trade, once that object is ended, then so too is the partnership ended. L is lapse of time. If a partnership is created for a fixed period of time, then on the expiration of that time, then the partnership automatically will cease. Now those 6 are all matters of fact. The person is dead, the person is insolvent, the share has been charged, or notice has been sent, the venture is finished, or the 5-year period for which the partnership was created, that 5-year period is finished. Those are all matters of fact and do not require anyone to go to court to persuade the court. The remaining 6 are all matters of subjective assessment, and it's a matter then of persuading the court that your argument is right and somebody else is presumably disputing it and saying no, they're wrong, their claim is unjustified. So you is unable to carry out one's share of the partnership agreement. If you and I are in partnership, and you allege that I am no longer capable of carrying out my share of the partnership agreement, and I say that I am, then you may go to court and ask the court and say, will you declare that this person is not fit to carry on and carry out his share of the partnership? And the court may agree with you, in which case they would dissolve the partnership, or they may agree with me, in which case they wouldn't dissolve the partnership, and we would have to resolve our differences in some other way. So, unable to carry out one's share of the partnership agreement, by persuading the court, you may get the dissolution order that you required. T is termination by the court under the grounds of just and equitable. We had just and equitable dissolutions or just and equitable liquidations in company law, where the cases Ebrahimi and Westbourne Gallery and Yenidji Tobacco and German Date Coffee Company. These were all liquidations granted or ordered by the court in the circumstance when it was just and equitable. Well, the same principles will apply to partnership law. I is for insanity. Where it is alleged that one partner is insane, then the remaining partners may approach the court and ask for the courts to dissolve the firm, to dissolve the partnership. Of course it's open to negotiation, open to argument, and the one who is alleged to be insane may say, listen, I'm not insane at all, it's these other people who are mad. So it's open to discussion. O is where it is alleged that the partnership is only capable of carrying on at a loss. Again, you can see that this is open to discussion as well. But where one partner says our business was to acquire and paint and sell dinosaur eggs, but of course the supply of dinosaur eggs is not great, if the business cannot continue except at a loss, then that would be a ground for the courts to grant a dissolution order. Why? Well, because the business is no longer capable of satisfying the definition. The relationship between two or more people carrying on business in common with a view to profit. And if it's only capable of carrying on at a loss, then it cannot satisfy the definition. N is nefarious conduct. Nefarious conduct is where a partner is guilty of conduct which is calculated to affect the carrying on of the partnership prejudicially. Conduct likely to affect the carrying on of the partnership prejudicially. So where there's arguments or where one partner in their private life commits some activity which then maybe goes to court and as a result of that brings bad will to the firm's name, then the carrying on or guilty of acts likely to affect the carrying on of the partnership prejudicially, it may be that we can justifiably ask the court to bring the partnership to an end on those grounds. And S is for surety conduct. And surety conduct, I know it's contrived, but it gives the mnemonic dissolutions. But surety conduct is where a partner is persistently in breach of the partnership agreement, persistently refusing to carry out their share of the partnership agreement, persistently failing to assign or approve or prepare accounts. Persistent breaches of the partnership agreement would be the basis for approaching the court and asking for a dissolution order. I have a little bit of a problem with dissolutions. It's not much, but if you think about it, there's an I at the top there, and there's another I down here. And we've got a similar problem with two S's up here and an S down at the bottom. We also have the problem with the O and the O down here. But if you remember that line, above that line, these are matters of fact. There is no dispute about this. The person is dead. The person is insolvent. The lapse of time has occurred. These matters above are all matters of fact rather than matters of subjective assessment. These are all objective rather than the bottom six, which are all subjective. We come to the Limited Partnerships Act of 1907 and the Limited Liability Partnership Act of 2000. And this was a recent exam question too. Limited Partnerships Act of 1907 said that at least one partner had to have unlimited liability, one general partner, and one limited partner who enjoyed the attribute of limited liability. Must be registered with the Registrar of Companies, and the limited partner should take no part in the management of the firm. But if he does take part in the management of the firm, then he becomes liable for the debts and liabilities incurred during that period. If the firm then does later become bankrupt, only the general partners will be liable for the firm's debts. It was a way that a partner was able to limit their liability. Past exam questions have indicated that where there are three partners, maybe it was agreed that one should have limited liability, but of course that agreement is ineffective as concerns an innocent third party who was not aware of this limitation and where the partnership had not been registered with the Registrar of Companies. Limited Liability Partnerships Act of 2000, the main features are the fact that this piece of relatively new, 10 years old piece of legislation is a recent attempt to combine the better characteristics of company law with the better characteristics of partnership law. Again, such a limited liability partnership must be registered with the registrar, and they have to file financial statements which must be audited. As a separate legal entity, the partners are no longer liable for the firm's debts. So they build a ring fence around their assets, so that in the event of, for instance, negligence by one partner, giving rise to an enormous legal liability for the firm, in the past, before this limitation was available, those partners had to foot the bill, they had to pay the money, and therefore their own personal assets were at great risk. But by the establishment of this principle of limited liability partnership, it does mean that partners are able to protect their own personal assets. However, provisions relating to wrongful and fraudulent trading, which we came across in company law, they do apply, and in the event that a partner may be found to be guilty of allowing wrongful or committing fraudulent activity, then the court may determine personal liability in such amounts as the court may seem fit. And that brings about the end of partnership.